The government bond market is currently in the danger zone. This isn't something I'm just saying or making up to sound cool. This is actually what analysts from HSBC have said. After seeing the yield on the 30-year U.S. Treasury bond hit a high of 5.2%, and the yields on government bonds from many countries, especially long-term bonds, have risen so much that they're calling it the danger zone. Because this is a zone where other parts of the financial sector could collapse as a result. The question is, how will the Fed solve this problem? If they raise interest rates any further, the stock market could crash. But if they lower interest rates any further, the bond market could collapse. So what should they do? Should they try to increase revenue by raising taxes? Or should they cut spending and reduce welfare, which could cost them votes in the election? Or in the end, maybe they just don't want to ask anyone or put it to a vote and simply print more money. And the problem is that what's happening now is that government bond yields are already high. And when people say the market is going to crash, it's because of inflation. But the way the government is trying to solve the problem is actually making inflation even worse. Plus, the Strait of Hormuz has been closed for a long time, so oil prices just keep going up and up. Now, inflation is going to get even worse. And in this video, we're going to explain to you point by point how the government's actions have led to these problems and why these issues are happening. The government just keeps repeating the same actions, and it goes around in circles. You can support the information in the bond market in the Danger Zone clip from Psy Money Monster by scanning this QR code. Or you can support the Psy Money Monster channel by liking, sharing, or leaving a comment to chat with us. And what I'd really love for you to do most is to hit the subscribe button. Or if anyone is interested in supporting the Psy Money Monster channel for the long term, you can become a member. Memberships are available. We are going to begin this specific clip by looking back at the time when the U.S. government officially opened up a public auction for 30-year government bonds, valued at $25 billion. After just 1 week, the yield, or the interest rate, or the return on the U.S. 30-year government bonds reached its highest peak level of 5.2% on May 19th, which the yield on the benchmark 30-year government bond is reaching 5.2%. That's the highest it's been since the year 2007. And what exactly was 2007? It was the very edge of a massive financial cliff, right before we fell into the subprime debt crisis in 2008. And this specific point, where the yield is sitting at 5.2%, is what analysts at HSBC are now calling the danger zone, because it's the point where the total cost of borrowing costs become too expensive, so expensive that it could cause other sectors of the financial industry to collapse as well. And this danger zone we're seeing in government bonds and other bonds isn't just happening in the United States. It's also showing up in the long-term borrowing costs of many other countries, like Canada, France, Spain, Portugal, and the Netherlands. Even Germany's 30-year government bond yield has climbed as high as 3.5%. You might say, oh, it's only 3.5%. That's still much lower than in America. But a 3.5% yield on Germany's 30-year government bonds is actually considered high because it makes borrowing costs in Germany more expensive than they can really handle right now. As a result, the German government is forecasting that GDP growth this year will be less than 1%, just 0.5%. So that 3.5% yield is actually a lot for them, because this means that the interest rate the government has to pay is almost equal to the rate of economic growth in Germany. As for the UK, their 30-year government bonds are also offering high yields, 5.6%, which is the highest since 1998. And then there's Japan, which is the most concerning. Japan has been trying for 30 years to get some inflation going in the country, but all those efforts have failed until now. Not long ago, they finally succeeded, causing Japan's 20-year government bonds to spike sharply, reaching 3.5%. This is unusual for Japan because before, the rate was just barely above zero. And besides the major countries I just mentioned, honestly, right now, what we call emerging markets are seeing the highest rate of selling off U.S. government bonds since 2023. So why is this happening? This situation happened because everyone urgently needs dollars. They need the money to buy oil because of the war that broke out in America earlier. That's what caused the Strait of Hormuz to be closed for 3 months now. The oil crisis has arrived, and everyone is running short on oil. So what's in demand right now is dollars to buy oil. Why? Because America made agreements that oil must be purchased with dollars. That's why today, everyone. So how do they get dollars quickly? By selling U.S. assets. And the easiest asset to sell is U.S. government bonds. The more they sell, the fewer buyers there are. And when demand drops but supply stays the same, the price falls and yields shoot up. Plus, there's this problem. If oil prices keep rising, U.S. government bond yields will go even higher. It's very likely they'll keep climbing. Because the senior vice president of ExxonMobil actually got up on stage at a conference in New York and said that oil reserves will drop to a critical level within the next 2 to 3 weeks. By the time this airs, it might be down to just 1 or 2 weeks left. And when that happens, oil prices will skyrocket. And he estimates that the price on paper could reach around $160 per barrel. If this really happens and there's an urgent need for cash and dollars, we're definitely in trouble. And what does that mean? It means that U.S. bond yields are also bound to rise. And if you ask, how important is the bond market? To put it simply, the easiest way to answer is, if you want to see its importance, just look at how big the bond market is. Because if you ask which asset market, excluding real estate, is the largest in the world, it's the bond market. According to data from SIFMA Capital Markets, the global bond market is valued at as much as $145.1 trillion. The U.S. bond market is even bigger than the entire global stock market because the total value of all global stocks is only $126.7 trillion. So if the bond market were to crash, it could actually be scarier than a stock market crash. Why? Just think about it simply. I'm not saying it will happen, but just imagine. If the bond market is worth $145 trillion, if bonds around the world, if, on average, prices dropped by about 10%, that would mean the market would lose $14.5 trillion in value. That's like half of the entire gold market disappearing, just like that. So with a move like this, the question is, hey, can the bond market crash? And if it does, what would it look like? Would it be like a stock market crash? To answer the first part, yes, it can crash. Any asset market can crash, and the bond market is no exception. For example, if there's a default, like people start defaulting on their debts, then yes, it can crash. But when the bond market crashes, it's not exactly the same as a stock market crash. When the stock market crashes, we might see stock prices plummet because the market is a lot of bankruptcies and things like that. But the way a bond market crash looks is that bond prices drop sharply and yields shoot up really high, just like what happened with government bonds that I mentioned earlier. But to be clear, I'm not saying the government bond market has crashed yet. And yeah, in this video, we also need to talk about what it actually means when yields are high. If you ask, hey, has the bond market ever actually crashed? Honestly, if you say it totally crashed, maybe not quite to that extent. But if you call it a collapse, yeah, that's happened. For example, in 1994, there was an event known as the Great Bond Massacre, or as I like to call it in Thai, the 1994 Bond Market Massacre. That name sounds pretty intense, right? This was an event that bond investors of that era, they were the most scared because back in 1994, communication wasn't as fast as it is today. No one could keep up with Fed news instantly like now. Then, out of nowhere, the Fed raised interest rates faster than the market expected. If you look at the graph, at the beginning of the year, the policy interest rate was at 6.4%. By the end of the year, it had jumped to 8.1%. That's within just 12 months, really fast for that era. And when yields go up, for bonds, if the yield is high, bond prices drop. At that time, this caused bonds all over the world to be dumped, and their market value just disappeared. $1.5 trillion gone. That amount of money was enormous back in 1994. Or if we look at more recent times, in 2022, it was the worst in modern history, right after inflation surged and the former Fed chair everyone is familiar with. Jerome Powell raised the policy interest rate from 0, shooting it up to 4% really fast. I still remember that day, sitting there watching the Bitcoin chart. Wow, it just crashed, all red, like a sea of blood. At that time, the price of the 20-year US government bond dropped by 30%. The New York Fed even stated that this was the largest sell-off of government bonds in decades. Many media outlets even name that event the worst bond bear market in history. And what's strange is, usually the bonds market and the stock market move in opposite directions. If one goes down, the other goes up. But what was special about that year was that both the bonds market crashed and the stock market fell too. So there was news at the time saying that the popular asset allocation strategy, like the 60-40 split, bonds 60, stocks 40, something like that. For anyone who followed this formula completely, after hearing all this, some people might ask, why not just call it a bond market crash and be done with it? Why do we have to say it was a severe downturn or something like that? It's hard to say, and this difficulty needs to be explained. Because if you say the bond market crashed, it should mean there's no money left to pay at all. But as we've seen so far, the media keeps talking about it all the time. The bond market is going to crash, it's going to crash, it's going to crash. But does it usually crash? Not really. You could say the bond market is always ready to do a backflip and make the forecasters look bad, because this market has a certain murkiness to it. Believe it or not, even if yields or interest rates get really high, what creditors fear the most isn't actually that they'll get their money back or not. What creditors fear the most is exactly how much that lump sum will actually be worth when they finally get it back. It's all about inflation. It is essentially the same issue. Just suppose for a moment you lend someone money and that person happens to be able to print money. While you're lending them money, they just keep printing more and more. You lend them money and say, okay, pay me back in 30 years. All the while, year after year, they just keep printing money like crazy. And every time they print more, the value of the money keeps dropping. That's inflation. So of course, if you're the creditor and you see your debtor doing this all the time, it's infuriating, because that's exactly how printing money causes inflation, and inflation erodes the value of the debt. That's why creditors, or people who buy bonds, they don't accept inflation. But with all the trade conflicts, the collapse of globalization, the Iran war, the closing of the Strait of Hormuz causing a 20% drop in oil supply, all sorts of supply chain disruptions leading to an energy crisis, a fertilizer crisis, a food crisis, and even the issue of the population aging faster than the government can handle, all of these indicators point in the same direction. Yes, inflation is definitely gonna. So up to this point, remember that the higher the inflation, the less creditors like it. And if creditors don't like it, bond yields will go up even more. Now, if you ask whether long-term government bonds have a chance to go up even higher, take a look at this data. Bank of America found that 62% of fund managers believe that the 30-year US government bond has a chance to surge even higher. They predict it could hit 6% by the end of this year. Now, let's continue. What happens when government bond yields get expensive? If they get really expensive, it means borrowing costs go up, right? That can cause companies to fail, and it can crash the stock market. And these higher bond yields are actually one of the mechanisms that can bring down the stock market. It can drop for the first reason, which is the traditional beliefs. Even though things have changed these days, there are still people who believe this, that government bonds are like a safe haven. They're considered safe assets. Even though today we don't really know if they're safe or not, there are still people who believe that government bonds are safe assets. And if government bond yields are high, it causes money to flow out of other asset markets, like out of stocks, crypto, things like that, into safe assets. It's like if you invest in stocks and you're not sure if you'll even get a 5% return, you might end up losing money with all the ups and downs. So maybe it's better to just put your money in bonds instead. You're guaranteed to get 5%. That's the kind of thinking people have. And besides that, when bond interest rates are high, that interest seeps into every part of the economy. It becomes a higher financial cost for everything. And by everything, I mean it trickles down to things like higher mortgage rates, which makes the housing market struggle. People end up having to use more of their money to pay off debt instead of spending it on living their lives, shopping, or buying things. That's the picture for individuals. But if we're talking about publicly listed companies or business operators, those who have taken on a lot of debt are going to be hit even harder. And the industry with the most debt among all industries in the United States right now isn't anyone else. It's AI. AI is huge right now. What's important is that the ones absorbing all this AI debt aren't even banks. It's actually private credit groups. Private credit is having problems right now too. You can check out the private credit clip to see that this sector is also on the verge of breaking down because it's already absorbed about $2 trillion in debt. Will AI be able to generate enough profit to pay back the principal and interest? No one can answer that. And importantly, when they issued these loans, they used floating rates. Floating rates work well when interest rates are low, but if interest rates aren't low, it can go up as much as it wants, right? That's the thing about these rates. This is another issue for companies that have borrowed a lot, especially those borrowing outside the banking system, like with private credit. And if they borrow at a floating rate, it just keeps going. Who knows how high the interest will go? So in summary, listed companies that have borrowed money will see their borrowing costs rise accordingly, following the increase in interest rates. As for the government, let's talk about the government side. The US government right now has a public debt of $39 trillion. How much do you think they have to pay in interest each year? Right now, the US government has to pay a debt burden, including interest, of $1 trillion per year. And that's an expense that's even higher than the defense budget. And last year, the entire US defense budget was just over $900 billion, but the debt is already at $1 trillion. In a work called Ferguson Laws, written by Niall Ferguson, he clearly states that any superpower that spends more on debt payments than on its defense budget is at risk of losing its superpower status. The United States has already crossed that line. So the question is there a way out right now? Can the Fed do anything? The answer is maybe, but the options are very limited. When it comes to how the Fed can really handle such a massive economic and financial problem, there are basically only two main choices: raise or lower interest rates. But right now, whether they raise or lower rates, everything will collapse. Let's start with this issue: inflation. Inflation has been extremely high since the war began. Oil prices have already gone up by 60%, and jet fuel prices have increased by 58%. Gasoline prices have gone up by 52%, European natural gas has increased by 54%, and fertilizer prices have risen by 20%. All of this becomes part of the cost of the goods we buy. This has caused the Producer Price Index, or PPI, to rise to 6%, and the CPI is now at 3.8%, which is above the Fed's target of 2%. That means 3.8% is almost double the target inflation rate. So you might ask, with inflation this high, why doesn't the Fed just aggressively raise interest rates? You might ask, has there ever been a time in history when a Fed chair just went all out and aggressively tackled inflation? Yes, there was. In 1970, the Fed chair at that time was Paul Volcker. He took the most aggressive approach by raising the policy interest rate all the way to 20%. That was a wild move. Back then, in the early 1980s, it caused the entire industrial sector to take a nosedive. People were furious, acting like they'd lost their minds. They didn't know what else to do, so they just dumped everything on the Fed. Car dealers who couldn't sell their cars would send the car keys and pile them up at the Fed. There were even stories that back then, Paul Volcker received wooden planks from home builders sent right to the front of the Fed, and he put them in a museum. Some people joke that later on, Jerome Powell might have to use those planks to patch up the Fed after it got battered just as badly. But if you ask whether what Paul Volcker did back then, raising interest rates, to crush inflation with rates hitting 20%? Was that a good thing? Well, yes, because it led to a long era of low interest rates, lasting another 4 decades, and a bond market that was peaceful for 40 years. But if you ask why it was possible back then, why Paul Volcker could do it, it's because at that time, if you look at the US government, its debt was only about 30% of GDP. So even if interest rates went up another 2%, the government could still afford to pay its debts. But today, the US national debt, which is $39 trillion, is nowhere near 30%. It's actually up to 120% of GDP. And just the interest alone is already $1 trillion a year. If they keep raising interest rates any further, honestly, we just can't afford to pay it anymore, my friends. So how about this? Why not just lower the interest rates altogether? Let the economy heat up, really get things going. If AI is going to boom, let it boom all the way. Can we do that? Well, actually, we can't, because if we lower the interest rates, the bond market will really collapse. Why? Because inflation will skyrocket. When inflation is high, creditors don't like it. When creditors don't like it, yields go up. And when yields go way up, bond prices fall. People will start dumping bonds. And in the end, if government bond yields really go up a lot, it'll just end up raising borrowing costs anyway. And the important thing is, do you know what? Right now, there's a possibility that even if we slam interest rates all the way down, it might not be as effective as it used to be. Will it have an effect? Sure, it'll have some effect, but will it work as well as it did before? Maybe not. Right now, the debt level is already really high. Lowering interest rates is meant to reduce borrowing costs so that people will take out loans to help expand the economy. The problem is, debt is already high. People are already deep in debt and can't afford to borrow more. And what about the banks? Are banks really going to be eager to lend easily, even if interest rates are at rock bottom? Maybe not. Just look at Thailand. Right now, the policy interest rate is 1%. So is it easy to get a loan? So can bond yields go even higher, and why? The answer is yes, they likely can. Like I said, people are selling off like crazy. When small investors sell, it's one thing. But if big players like China and Japan, the top US creditors, start selling, that's a whole different story. China was once the top holder of US bonds. It wants at 1.3 trillion US dollars, but China has been selling off continuously for 17 years in a row. Now, China holds only about $650 billion in US government bonds. As for Japan, it's not that they dislike America and want to sell US bonds, but Japan has to sell US government bonds to maintain the value of the yen. And what's important is that Japan is a country that has to import 90% of its energy. But now, with the energy crisis, because America went to war and shut down the Hormuz Strait, so there's no oil, Japan is facing an energy crisis. So, as I mentioned earlier, when there's an energy crisis, they need money to buy oil. And what currency do they use to buy oil? It's the US dollar, because America set it up that way. You have to use dollars to buy oil. So, what's the easiest way for Japan to get US dollars? It's by selling US government bonds. Yes, other countries are in the same situation as Japan. They have to sell off large amounts of US government bonds. Saudi Arabia, India, the UAE, Norway, Singapore, they all do the same thing. And every time people sell off US government bonds, it means the demand for those bonds goes down, which means America has to pay higher yields to attract new buyers to replace them. So let me ask, since I'm a curious person, so I asked, well, if you really can't find any new customers at all, who are you going to sell to? And the answer is they just sell to other Americans. How do they sell? It's not like they're out there selling to individuals one by one. They sell through pension funds, passive funds, things like that. I'll make a video about this topic soon. Let's talk about some of the biggest IPOs in history, specifically these three major IPOs: SpaceX, OpenAI, and Anthropic. Honestly, it's incredibly intense and significant because just this past May, NASDAQ actually officially updated their regulatory rules so that pension funds and passive income funds could be the ones to buy up these three IPOs. Hold on for now. Hit subscribe. I'm still writing, but it'll be on soon, just a few more days. But let's get back to the bond market for a second. So what happens if, in the end, all those funds I mentioned still don't have enough buying power to meet the demand for borrowing? Well, in the end, the Fed just prints more money to buy its own debt. This move is something they can actually do. Let me show you the US debt again. The US public debt is $39 trillion, and it's still going up, increasing by about $2.5 trillion a year. Now, let's look at how much revenue the government brings in. The US government collects about $5.23 trillion a year in tax revenue. As for expenses, those include things like Medicare, welfare, and other social programs. It's at $7 trillion a year, which is more than the tax revenue. And the interest on the debt alone is $1 trillion a year, way over. This means the US government has been spending more than it takes in for a very, very long time. Mathematically, this means expenses will never match revenue, and the only thing that will happen is the debt will keep increasing. In the end, there's only one way this can end. That is, the Fed has to print money to cover the part they can't pay. And what does that mean? Let me emphasize again. It means inflation. Creditors don't like inflation, and it will cause bond yields to rise. When bond yields go up, bond prices drop sharply, and people will rush to sell off their bonds, which will make bond yields rise even more. It could go even higher than this, but some people say that debt won't actually cause a collapse. Me would rather call it an extremely expensive correction. And if you ask what we can do, it's to prepare by holding assets that aren't affected by inflation, because government money will definitely inflate.